The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good morning and happy Friday, everybody. Thanks for tuning in. It's going to be an exciting Friday, man. I'm excited for this trading day. I think we're going to get some two-way action at one point or the other, but boy, we're going to find out at 9:30. Pretty remarkable action considering you get a print this morning. I'm sure you're all somewhat aware if you're watching this program. The jobs number at 8:30 this morning, 311,000 jobs added. The expectation was for about 225. This is following 500,000 plus jobs added in January. I think there was a revision of something like 20,000. Not much, not even sure which way it went. Very, very marginal revision to January. So that holds to about 500,000. February, a 28-day month, comes in at 311,000. I believe if you do the 3-month average from December, you're talking about somewhere in the high 300s in terms of that number. Let's jump over real quick. What was December's number in there? There it is right there, 239. So you average those out, I think you're talking about 370-something. Was watching it on Bloomberg early this morning. The unemployment rate rising to 3.6%, and then you have wage growth, okay, waning a bit under the expectation. Wages on a monthly basis up 0.2%. Market was looking for 0.3%. On a yearly basis, up 4.6%. Market was looking for about 4.7%. Pretty remarkable action, because all the talk prior to this number was that if we get a hot jobs number, man, we get the Fed, we have Chairman Powell, what he was talking about, higher rates, that would probably tip it to 50. And what happens, man? The swaps rate, no, swaps are now pricing in 25. They just might have enough room. We're going to find out, though, man, because today it's going to be an interesting one. Quite the day yesterday. We'll talk about the banks in a moment as well. SIVB halted as of right now after being down an additional 60% in the pre-market coming into the open today. They're going to have news shortly. That'll probably break while we're on the air. Let's jump over to that chart real quick. Yeah, sitting at about $40 down from 106. That's where, I mean, folks, if you were in this equity yesterday, hindsight's always 20/20. I was not in that. Easy for me to say, right? But I'm not sure what the impetus would have been to hold. The impetus is always that maybe it'll bounce back up. But boy, you see the risk there as you go from 100, and who knows, this thing might open at 0 when you look at it. And we got the S&Ps. I mean, that was some volatility on the number. That's a 5-minute chart. Let's put it on a 1-minute so you can really see. I was watching this thing live tick around. Pretty interesting to see the up and the down spikes after the numbers came out. You kind of understood it because of the divergence in terms of more jobs added, but those jobs added with lower wages than expected, right? It's not lower wages. Wages went up on a monthly basis, 0.2%, on a yearly basis, 4.6%, but just a little bit light of the expectation. But man, 311,000, pretty remarkable. This market's held up. We're going to see if that holds on the open, though. In about 20 minutes from right now, S&P's up by 6, NASDAQ 100 up by 54. You see the volatility there. Now, context as well, man. All we're doing right now, folks, I mean, to check it out. We're trading at 39.26, okay? Here's the close of action yesterday. Close of action yesterday, we got some huge volume in the final minute as closing trades, but this is the final few minutes. Where are we trading at right now? 39.28. We're trading at where the market was at 3:55 p.m. Eastern time yesterday. Remember how you felt about that market at 3:55 p.m. Eastern time yesterday. And now we got 311,000 jobs after it. I know the wages are there, man. But boy, that's not how the economy is going to work, folks, in terms of 500,000 jobs, 300,000 jobs add. That's a 28-day month, too. You got to consider it, man. 28-day month, still crushing 300,000, 100,000 more than the market expectation. Now, we jump to commodities. Crude catches a little bit of a lift on that number, but nonetheless, we're under 76 bucks at 75.75. We have some action, of course. Let's jump to the dollar before we jump to gold, because there's your drop in the dollar. Now, what do we have? We jump to the dollar. You got a weaker dollar. We have, lower yield. Yeah, what are we at? We're at something. Let me see what we're at right now in terms of the 10-year yield. You're talking about a 10-year yield at 3.77%. Remarkable. We were just sitting at 3.77%. Man, you got to love this market. The 30-year up a full 2 points and 7 ticks. We hit 128.20, and that's 19 ticks off of the spike. The spikes were crazy, man. Let's go back to the 1 minute so you can see the action on the 10-year. You spiked to 113.04, and these are 1 minute charts. And a couple minutes later, you were back to 112.13. And then we just traded and gave it all back, right? Check that out. We gave it all back in the 10-year. Now we're up from there. It's going to be a volatile Friday. Pretty interesting. We're opening up 4 points, right? Pretty calm. Dow negative. Russell negative by less than a point. NASDAQ in the positive and S&P's in the positive. We jump over to the VIX as we jump around right now. Excuse me. Makes it to about 23 at the close yesterday. We're backing off a bit as you take a little bit of volatility out of the market. And that would make sense because we have a big data point that's no longer in the market in terms of we have the jobs data. And boy, it's going to be an interesting open, man. I haven't been excited like this for an open in a while, as in it's an important data point. Now, all it does is add to Tuesday. But how many people would have said, I'm betting on a number of 300,000 plus jobs added, and when that number hits, the S&Ps will be up 7 points. It was quite a day yesterday, so some of that priced in. Okay, that's one thing to consider, man. If you're bearish, right, on a percentage basis, okay, the highs of 4,080, let's just do it. 4,080 down to about the lows of yesterday's close. We'll call it even 39.20. That's a 160-point move, which is a 4% drop from Monday's high. So you just pull back 4%, coming into 39.20 from 4,080, right? That's 160 points, basically 4% on the drop. Skews the risk reward slight a bit when you get a 4% pullback on a weekly basis. And meanwhile, we get the jobs number that does have wages that are not as hot as maybe they were thinking. So I'll give you both cases, but man, the market's still sitting at 39.25, right? 4,000 is quite a pretty price point on the S&Ps when, man, we just cannot get this job market under control. 3.6% unemployment. Yes, we go up, but we go up from historic lows of 3.4, and we're still adding 311,000 jobs. What's so fascinating about so many of these data points, right? Ask yourself, doesn't it seem like within every data point, there's ammunition for any argument you want to make on both sides that actually is reasonable? And that's what makes this market so fascinating, because there is a realistic argument that if wages start to come down, okay, maybe they're lower paying jobs, so those wages are going to come down. There's not going to be as much impetus for those companies to be paying more, causing them to raise prices. So many factors could be coming into this. But man, headline number, I don't know. That's a spicy headline number following the day yesterday. And with 1 minute left in the first segment, we'll do a little bit of teaser to get over. Before we do, you know what? I was going to tease the SVP shares, Silicon Valley Bank, and we already took a look at that thing, right? Check this out. Did we? Maybe I was just looking at it this morning. Yeah, we did. Yeah, pretty remarkable. Nonetheless, the jobs number, there's your 311. I mean, folks, January was not a one-off. You know, you look at these numbers, okay? It's not a one-off to say the least in either way. And I got a couple other cool articles pulled up. We'll talk about them when we get back from the break. Yeah, we'll talk banks, man. And yeah, if you had your capital in there, folks, get your capital out. As Peter Thiel was telling his companies, there's no downside. Anytime there's a run on the bank, you make sure you run first to that bank, because you don't want to have to deal with the insurance. Why? There's no downside. That's the whole point. Stay tuned, folks. That's the problem as well that's going to be going on right now. We'll talk about that when we get back. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them, using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee, so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years years' experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
TFNN has launched the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Welcome back, folks. And how many times has the first new move not been the real move, and the second move has not been the real move sometimes? And guess what, man? We just might see a trading range. And in this market, folks, you can get a 40-point trading range in the S&P, and we can bounce around 2-3 times in a trading day. Pretty remarkable, but man, just like that, we got the S&Ps rolling over. We're negative by 7 points right now. NASDAQ 100 barely hanging on to gains. Dow off 86. Russell off by 9. Got to keep your eye on notes and bonds and the dollar to see what yields are doing right now. Yields somewhat chopping around, still a little bit lower. We got higher price. Okay, and I don't blame them. People flocking to safety, folks. Yeah, you better believe it in this market, man. Because if you don't think there are risks right now going on in this market, the Fed's been hiking for a year. It's March, right? They started last March is when they started hiking. The market had already, okay, let's pull it up to make sure we're all aware. Market gets ahead of the Fed, as it always does, right? Trades from a price point of 4,800 down to a price point of about 4,153. The Fed comes in with a hike, I believe it was March 14th. Boom, you catch an acceleration that week. You trade all the way up to 4,600 before the real run starts of 1,000 points in the S&P to the downside. Point being, you got ahead of where we were in the market, okay? And we've been hiking for a year, and the rhetoric has basically been everything is ho-hum. Right, man, this economy is marching on so much. Inflation is raging. There are no cracks anywhere in the financial system. And I think that was a game changer yesterday because it's surprising it took that long and for the market to figure out. And I think if I was like a bank analyst or you were just staring at those stocks or even just thinking about it to that concrete in your own life, okay? Because I know many people, folks, okay, who just in my personal life, right? You talk to, they're friends. They work a 9 to 5. They're successful. They save money. They're not as invested in the stock market as they probably should be, okay? And so they have a lot of money in savings. Well, for the longest time, that money, security, was in savings in their checking account, earning basically nothing. But that wasn't really a problem because there was nothing to earn because interest rates were nowhere. And it became a given that money was there and rates got to a point that every single person that is a saver that did not want to have money in the market, that probably had too much money in their bank account to make, they were not making the correct financial decisions. You still could have had it somewhere, probably getting a little bit better yield than in a random big bag bank account that's paying you very little of the interest rate, okay, especially as it rises, but rates were at zero. So it's pretty marginal, right, in terms of what you can get. Point being, I saw it happen, folks. I saw friends that had 6 figures in savings, okay, take that out of the bank immediately and put it into a simple money market, and now it's doing some CD work, right? It's looking at potential treasuries, got into some I bonds last year, right? Where did that money come from? The banks, okay? So it's going to be a big issue. We've already seen the numbers, right? I was talking to my dad last night. It came out 2-3 weeks ago, whatever it was, the biggest withdrawals in banks and deposits that we've seen in X number of years, X number of decades. It's going to be an issue, man. You saw it yesterday. Now, this is, listen, we got some great conversation in the den. Our man Jimmy, he's putting out some great information, man, talking about banks, talking about how they are somewhat of an individual case, SVB, Silicon Valley Bank. But it is going to be interesting to see how this hits the banking sector. And guess what? As the banking sector gets tight, money becomes tight. Money becomes tight, growth becomes tight, and that really cramps things up. And this might be the first witness. It is the first witness of kind of that cramping up. And some of the statistics, okay, on this bank, let's jump around. I got too many articles to keep track of somewhat for Silicon Valley Bank. Yeah, as they are halted right now, and I know they're talking about in the den potentially looking for a suitor. Okay, that could possibly make sense. They are involved in something like half of venture capital somewhere in the mix. They have half or something to that degree. Let me see if I can find this, man. Is this the article? Okay, I'll pull it up after the break when we get into the open. Is that it? Okay, I'll find it after the break. Oh, here we go. Okay. I'll find it after the break. Like 50% of venture-backed startups do business with this bank. 50% of venture-backed startups do business with that bank. Whew. So there's going to be an impetus to have somebody try and step in. I think it was Ackman. Bill Ackman was out there, I think, on Twitter talking about that. You know, you let that dry up, man. You got all these growth venture-backed companies in the wheelhouse of that bank, and that dries that up, and that's actually the future. It's a decent argument to be made, but guess what, man? That bank has been churning profits. Pretty remarkable, folks. You're taking all this money from consumers, okay? And listen, this is a different bank, okay? But it does not change the issue that is front and center that I don't think a lot of people really realized was going to be so dramatic, because if they did, right, this time is different in the banks, folks, okay? Because everybody was used to 0% for so long that there was a cash buildup in accounts. Because for the longest time, 10 years, 15 years, you didn't feel that bad if you just wanted to be in cash. The market had been through some tumultuous times, 2008, 2014. Maybe you just want to be in cash. Well, you could keep it in your bank account, and really you weren't making a massive error because there was really not too much yield to go around. So what did that do? Savers built up all this money in their bank accounts. Rates began to rise. Banks had that money on their balance sheet. They loaned that money out at 0% interest rate. I'm exaggerating, but this is the point, right? And then what happened? All the people said, hey, you're not giving us this yield. I'm going to take that money and I'm going to go somewhere else. And when you take that money and go somewhere else, what has to happen? The bank, they have to close that position. Well, what happened? When they have to close the position, they had that position earning 0%, and now the rates have just spiked. Well, what happens? Price goes down, yield goes up. In order to sell that, they're going to take a substantial loss. So at the same time is they're losing all their customer funds, and to shore up that equity, they're taking losses in the investments they made at very poor interest rates when deposits were at all-time highs. It's going to be a saucy, spicy open, man. I would be careful of the banks. Now, the good banks are going to be fine, okay? But that doesn't mean that the tightness might hit them, man. And I think you're going to feel the banks that are very reliant on that. We saw some big interest income numbers, but guess what, man? People are not stupid, okay? And I say it as in, there's just been an impetus not to move that money out for the longest time. You could keep tens of thousands, if not hundreds of thousands of dollars in your bank account, folks. And you really weren't foregoing too much of an opportunity cost when rates were hovering at historic lows. And people who did that we're not fools when you started hearing that you could make 3 to 4% on your money, because if you had $50,000 to $100,000, you are talking about thousands of dollars a year. And that is enough to make the change. And there hasn't been in a very long time that I know, there hasn't been that big of a change to actually make the consumer switch bank accounts, because it is a very, very difficult process. It's not. It's a very easy process, but people don't like change. And changing your bank account, taking that money out, putting it somewhere else, it's a transaction that you have to get over. But boy, I'm telling you that there's substantial risk here, because that's a bigger issue. Everybody was talking about interest income, right? Nobody was talking about when rates go up, banks aren't going to follow the interest rate up, so people are going to take out deposits. No, because normally they don't. Normally they don't take out deposits, and banks make that money for people kind of being lazy and keeping their cash in there. But this time, the difference is too much, and so they're taking that money out. S&P's negative by 9. We're coming back for the open. Stay tuned.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern, for free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Okay, welcome back, folks. We got the S&Ps open up slightly in the red. No huge movement in terms of the first 30 seconds of action, but we are negative across the board with the S&Ps down by 10, NASDAQ 100 off by 8, Dow off by 71, and the Russell in the red by 16 right now. Crude prices, 75.67. You see the volatility on that crude number, right? 75 up to 76. We've backed off a bit. You get the gold contract catching a bit. We have a weak dollar. And let's check out where we are at yields. Yeah, continuing to rise. Check that out, man. We got lower yield. We got a weaker dollar. We got stronger commodity prices in terms of gold up about $20 right now, but you have the market dropping with the S&P now off 12 points at 39.08. Let's see how the VIX is trading this morning. Volatility index, back to 2271. Yeah, let's go a little big picture here on the S&P, okay? Let's see how big picture I got to go. Yeah, not too big picture. I'm going to put it back. Zach, get me all of it? It does. A 20-day hourly gets you back to 41.86. February 13th. Today's March 10th. Just like that. What is that? What are we trading at? Market's dropping, man. S&P off 15. Watch out today, folks. 3,900 is still a relatively decent price, I think, when you encounter what we're dealing with in this market right now, in a market that has the potential to have inflation raging as we have a little bit of a run, at least on the small banks. And that's going to dry up capital, which is going to freeze up the economy. And then we may feel the hit on the economy, which will be the market worry as inflation cools over the next, 3-4 meetings, gives the Fed some room to hike at least 3 more 25 hikes or something like that. And then maybe we pause. You're seeing what's happening right now with where rates are, okay? What happens when they go up another almost full point, let alone if we get to 50? Seems like market wants to price out the 50 right now, but we'll see where we are by the end of the day. Now, you go back to this price point, okay? And I'm going to take like 41.40, maybe the area that I'll take, where do you find the top here when you talk about a Fibonacci? Maybe we'll choose like 41. Yeah, the double top we have here, what's that? 41.70, something like that. Let's see where we go. Let's add a drawing. Let's put our Fibonacci on here. Okay, and I'm going all the way down to the low. Look where we got to, folks. And where was that? That was Monday, I believe, right? Yeah, that was Monday. Right to the 618, okay? And I had posted this chart in the den when it was doing that 618, folks. Doesn't mean it's going to work all the time, but at least you have your back against the wall and you can make a trade. You set your stop somewhere above it. So just this week we were there, but the point being is, if this goes lower, okay, you're trading from 41.70 down to 39.30. It's about 240 S&P points is the A to B leg. Your C point is about 4,080, okay? That takes you out down to about 38.40 in this index to complete the A to B, C to D leg. Doesn't mean it's going to happen today, man, okay? But 38.40, maybe the 38.25 area. And where does that area line up to? Right where we were in the beginning of the year, okay? Not outlandish at all that's where we get to, folks. You got the S&Ps down by 9. It was a heck of a day yesterday. Even if you didn't have the banking deal going on, sprinkle in that we just got 311,000 jobs following 500,000. You add in what's going on with this bank, and I tell you, man, I'm going to try and figure out, I'll post this in the Tigers Den at least, because one of my buddies just sent me a link of Kramer pumping Silicon Valley Bank somewhere like last year as his pick of the year or this year or something like that. You can't make this stuff up, folks. You got to love it. Silicon Valley Bank, where was it? Because when he was pumping it, it was at 320. Yeah, so it was probably the high of this year. That's great. We'll pull it up because I believe when he was talking about it, it was at 320 or something like that. And he was saying Silicon Valley is always going to need money. It's always been a good business. One of his picks of the year, I believe. I'll try and post that in the den. So don't think that's not going to matter, man. And don't think that it didn't come out that a lot of people, okay, these banks, this was supposed to be an easy year for the banks, to put it lightly, but there was supposed to be a lot of easy money to be made from the earned interest income. And actually what's happening is that's turning into a magnificent problem for them on the downside. As in, it's just, you can't overstate it, man. Rates are rising. They're going to continue to rise. And that's going to continue to put strain. And you already have some banks. And listen, it is different in terms of people taking their money out of banks. Usually you just don't do that. And the rate differential right now is too extreme that everybody's doing it. And it got pushed to the limelight. Now, thank goodness for regulations, folks. Okay, people like to decry regulations. The banks want everything loose as they can get them, right? Yeah, this is why you don't let that happen, man, because this is how it can creep up, and the banks who aren't capitalized are going to have some issues, and that's what you're seeing play out with SIVB. And even if they don't go BK, okay, it's just going to be a real strain on those companies and those banks because they are dealing with issues that they probably didn't see coming down the line, because it's very difficult to anticipate the level of funds that are being withdrawn. Now, you got to run on the bank, man. You got to run on the bank. Very difficult to overcome a run on the bank. right? Very difficult. That's why we have FDIC insurance. So there's no runs on banks, because once you get the run, it's over, right? That's what, once it was going on yesterday, man, it was over. There's no reason to keep your money on that bank. None. As Teal said, absolute no downside to taking your money out. Take it out immediately. That's what you do overnight. Yeah, S&P's down by 20, 3,900 on the dot. Now, overnight, we had some negative action overnight, man. We were down to 38.84, right? You were down almost a full percent from where we closed yesterday. We're down a 0.5% right now, flirting with a pretty important number probably mentally at 39.01 right now in the S&Ps. It's going to be an interesting day no matter how it shakes out, man. And yeah, so SVP, we'll see where they go. Somebody may try and step in. There's going to be some that are saying that they want the government to bail them out if they don't. Maybe it was Ackman saying that already. Yeah. Whew, man. Okay. Jumping back to what else we have going on. Let's see. I'm going to jump back into the jobs numbers for a moment. Where we're going to go. Let's jump into the journal piece. So 311,000 jobs. The unemployment did rise to 3.6%. Payrolls gain marks cooling from hot start of the year. Now check out how cool this is, right? You pull up Bloomberg's front page. Cooling U.S. labor market hits minority groups first hardest. Quite a headline in terms of where's the 311,000. But they do good reporting and they go beyond the headline number, okay, which is what matters most, rightfully so. But nonetheless, you see, and then you go in and they talk about cooling as well, right? Payrolls gain marks cooling from hot start to the year. Folks, 311,000 jobs added with an unemployment rate of 3.6%, and you have the Journal and Bloomberg both putting out the word cooling. I just don't think that fairly represents the risks in this market. And check it out. As I'm talking about all this, right, what am I getting served ads with? A CD rate of 4.35% for 20 months from Marcus by Goldman Sachs. And I'm sure that's not even the best one out there. It's probably not. But you see, they're everywhere, okay? People are not keeping the money in banks, man, missing out on 2 to 3% of the money they can be getting. Savers for the long time were very comfortable there. And it's just going to be remarkable to see if it really does transition. Let's check out some of the big banks and see if they're getting anything today. Well, you got JP Morgan down more than the market right now, but not that bad considering you got an implosion with Silicon Valley. They're down 1.2%. Bank of America right now, look at this, right? Down 3.8%. Morgan Stanley down 1.3%. Goldman Sachs down 3.2%. Citigroup down 1.9%. Watch out, baby. Let's see what the BKX, the banking index. What are you doing? Whew. Yeah, down another, $4? Watch out, folks. Day is young. We'll be coming back. S&P's at 3,900 on the dot. Don't go away.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. S&P's right now negative by 27 points. I got a chart here of Signature Bank halted on circuit breakers, maybe down 25%. I don't even know if that's the deal. Halted nonetheless, man, as the banking contagion hits a couple different equities. And yeah, you're going to see runs on the bank. It's begun. That's it, right? You got money in there. It's gone. You think it's at risk. Pretty remarkable to see how this plays out, man, in the face of everything going on right now, that you're going to have this play out. And it's probably why you're seeing some of the bigger banks taking a hit. They're not going to be insolvent. Thank goodness for regulations. But boy, oh boy. Yeah. Whew. It's great. Yeah. I mean, Peter from Park City in the den. You got to get in the Tiger's Den, folks. Silicon Valley Bank, First Republic Bank, and Signature Bank. Those three banks. Who knows if it's true, all right? We're getting it. I'm not checking that data, but they have a lot of deposits, and you're talking about nearly $500 billion between just those three banks, $500 billion. And it would make sense, man, because I saw that statistic I was talking about this morning, that Silicon Valley Bank is something like they have a relationship with 50% of venture-backed tech startups or something like that. So I don't know where today goes. Following yesterday, man, do you really want to be long on the weekend to find out where capital is going to be okay in which bank come Monday and Tuesday if we get a hot CPI on top of it? That's some risk, man. And I know I'm just speaking generally, but that is some risk. And this market cannot find a bid right now. And what you're seeing is you're seeing a flood to risk off. Yields are dropping dramatically. People are taking their money out of the stock market and they are buying fixed income. And it's not stopping right now. And we're only 14 minutes into the trading day. So we have the 10-year at 3.72%. I think I started off the program at 3.77. We were just sitting at 4%, man, this week. Okay, what else do we have pulled up? Let's take a look. And yeah, get in the Tiger's Den as well, folks, because I did just post a link of that Kramer clip. And listen, you know, it is what it is, okay? I'm not really a fan of him. It is tough when you're out there every single night talking about what you think stocks are going to do, up or down. And, of course, at any time there'll be downturns, right? And you're going to get held accountable for anything you don't do when you're doing it 5 nights a week and you have to put out information on many, many different equities. And, of course, you're going to be wrong and right occasionally. But nonetheless, he was out there pumping it at $320, man. Silicon Valley Bank. And you don't think many banks, SIVB is their symbol, as it is halted, okay? And they're talking about, I'm seeing headlines coming out. And yeah, pretty sure he pushed this thing when it was like at the highs of the year, man, 320, somewhere around in this closure there. And you're talking about within a month, it goes BK. Silicon Valley Bank, 16th largest bank in the U.S. Yeah, so not something small. Great information in the Tiger's Den, folks. Get in there. We got an extraordinary time in this market going on right now. All right, Let's see what else I had pulled up here as we get lost in some of the headlines. We talked about the jobs. Peter Thiel talked about him, where the layoffs will be. Yeah, the banking system can. Okay, that's where, don't get confused between the two. That's the great thing to bring it up again, because boy, I don't like government overreach. I don't like government overreach when it comes to regulations, but government does serve a purpose, and that's the unfortunate part that gets lost in politics right now. It's either all or none. And that's, in my opinion, not the way it works, folks, because thank goodness, because you're seeing what could happen right now if banks weren't highly collateralized and tested often. When what happens? Everyone's pulling their money from the banks because they're not paying them interest. The banks have a lot of things on their balance sheet, and we haven't even talked about that some of those are mortgage-backed securities. What's happening? You have rich tenants. Maybe I can find this article that I was reading this morning. You have tenants with money that are not paying their bills anymore because it doesn't make sense for them to, for office space, for buildings, for things that are just taking massive hits, okay? So what's going to happen? Not only are they going to have to take a hit when it comes to holding things in terms of holding treasuries or just whatever it is on yield that you've seen yield spike. Market just keeps going down the whole time I'm talking right now, okay? But they're going to have, again, they're going to have, okay, some things backed by mortgages. And in that office space sector, especially anything below A class, it's going to be a tough hit, man. And I don't know, maybe we get there today. What'd I say, 38.40, right? It's not really the conservative, but you're taking the high from February 16th, folks, which is 41.68, okay? So I said 41.70. We took our B point of kind of the low of March 2nd, 39.25. Yeah, we'll call it 39.30. So you trade from 41.70 to 39.30, 240 points, give or take. We got a high of 4,080. That brings us down to 38.40. And we're only 40 points away from that price point, folks. And man, we're going to get there in 1 week. You could do it in 1 week. Imagine that. We could do a 240-point C to D leg in 5 trading days, and we're only 40 points away from it. So, hey, we'll see where we go, man. It's only 9:48 in the morning. The market's only been open for 28 minutes, and I don't know how you find a bid, because guess what, folks? My group chat with my friends today, do you know what we're talking about? We're talking about banks going under. We're talking about the jobs number, and we're all successful people in different areas of corporate life or just business in general, but we're all interested in the economy and the market and how it performs. We're talking about the banking crisis that's going on, right? We're talking about the run on the banks. We're talking about all that. We're not the only ones. Everybody is. What's the impetus to buy at 3,900 going into the weekend that we have banking problems on top of 311,000 jobs added? Doesn't mean the market's going to zero, folks, but it might mean that 3,900 is a bit overpriced even right now. Because all we're doing is we're just back to where this market was on January 19th, right? We're just back to where this market was on January 19th right now. So context is important. Probably an irrational run up to 4,200 when you think about that run. All right, let's jump around to some of the equities and see how we're reacting on the open. We'll put it back to a short-term time frame. Apple, pretty much in line with the market right now, down about 1%. You got the NASDAQ 100, right? Down about 1%. You jump over to Microsoft shares, down 1.3. There's a sell-off for you. $7 from where it was coming into the open for Microsoft. We jumped to Google shares this morning, down about 0.4%. Let's see how Tesla's trading. Down 1.4%. Meta shares, down about 0.7%. Some of my favorites. Look at Disney. Everything's paying the price here, man. Yeah, there's not going to be anywhere to hide, man. You know, even you look at strong dividend stocks, right? Everything trading south. Not VIX, excuse me. Just Verizon was looking at yesterday. You talk about the sell-off yesterday, man. Everything. There was no hiding at all in this market, folks. Let's see how the banks are doing. Look at JP Morgan actually holding up now. Catches a little bid from 127.82 to 130. Bank of America still down 3.5%. Yeah, there's going to be winners, losers, depending on where you transition, where you're positioned as a bank. I am not fundamentally well enough aware of the differences in some of these banks, but I do know, if you're in the less into that earned interest income deposit business, like maybe Goldman might be, but still, you say that, right? Goldman's down 3%, man. S&P's off 35. One more segment, folks. Don't go away. Stay tuned. We'll be right back to finish up the show.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We get a little bit of a bid in the market right now, still down 29 points, right? But we were about 38.78, so you're about 13 points off that low, but I think you're going to see some volatility all day, man. We're 24 minutes into the trading day, folks, on a Friday following a market collapse, and we just got 311,000 jobs, and we got a CPI on Tuesday. Again, what's the impetus to buy this market? I mean, eventually you might get there. We're down 4+% on the week. Important to keep that in context as well. The market has repriced itself with this data this week. But boy, 4%, we might have a little bit of a banking crisis going on. And yes, FDIC insurance will cover people, right? Those banks are regulated. They're the smaller banks. It's not going to destroy the economy like the big banks collapse who are regulated, but it will dry things up, and that's going to hurt the economy, to say the least. We'll take a look at some more charts of the jobs number as we step off the air, the final numbers. So 311,000 is the number you get. Does that look like a downtrend channel, folks? Remember, think about what was happening. August, September, October, November, December, declining numbers. And what just happened, man? We just got January, 500,000, February, 311,000, right? Yeah. Unemployment rate. Can you even see an uptick on that chart, folks? We're not even close to where we need to be, okay? hourly wages and CPI. Let me see if I can blow this up a bit. There we go. Hourly wages and CPI changed from a year earlier. Focus on the purple here. Leisure and hospitality, we're going up. Focus on service work providing workers. Service, we're actually going up. You could make the case, right? Staggering numbers here, folks. So be careful today, man. S&P is down by 30 again. We're under 38.90 right now. A lot of risk in this market to go into a weekend with the CPI coming up on Tuesday. And did you know yesterday that we were going to have Signature Bank getting halted? Did you know that? Did you know yesterday First Republic was going to be in trouble? You might have known that Silicon Valley Bank was going to be in trouble. But kudos to our man Frank with a nice short there. And I'm not sure what happens if you're short. Maybe somebody else can help us out in the den. If you're short and it does go to zero, I guess you collect all of it. I'm not sure. Not a bad trade, though, either way. Folks, thanks for tuning in to start your day. Stay tuned. We got our man Basil Chapman coming up next. It's going to be an interesting Friday, man. S&P's down 28 points right near the lows of the session. Have a great Friday. Have a great weekend, folks. We'll see you back here Monday. Stay tuned for Basil up next.